Thank you for checking out Fieldman, Rolapp Associates Municipal Market Update for the week of May 15th, 2023. This is our 48th posting. My name is Adam Bauer, and I serve as CEO and President of Fieldman, Rolapp Associates. Fieldman, Rolapp Associates is a municipal advisor to government, and our MMU is a monthly posting to provide our clients and other market participants some key data in the municipal market, and also provide some commentary on what we're seeing. So thank you for checking it out. On our first slide, we're focused on the Fed fund rate increases. And this is a chart we started 3 or 4 months ago. And what we're trying to highlight here to begin with is if you use the far right vertical axis, and then you look at those green bars, those are the Fed fund rate increases. Started in March of 22 with a 25 basis point. Then in May, we had 50. Then we had set 4 75 basis point increases. The yellow stair-stepping type line, that is the Fed funds rate. And what that takes into consideration is the accumulation of all those green bars. And you can see how that has trended upward as the Fed has increased its rates. An area that I think is very interesting is the light blue line, the 10-year US Treasury, was generally tracking upward the Fed funds rate. I think you can probably notice that with the light blue upward trend until about November. In November, the Fed chair, Jerome Powell, gave a speech, and it seems that the takeaway from that speech was there's still rate increases that are needed, but not to the same degree that had just been taking place over the last several months. Now, keep in mind, at that point in time, we had 4 75 basis point increases. And before that, we had a 50, and then before that, we had a 25. And so that was a significant amount of rate increases in a short period of time. And now you can see generally the 10-year Treasury doesn't seem to be following that yellow line. We'll see how long that trend continues or if it changes. But with the data we have available to us today, that's the takeaway that I see from that chart. Now, this is the US Treasury yield curve, and we compare January 1st, 2020, or I'm sorry, January 3rd, 2022 to May 12th, 2023. If you've seen the MMUs before, what I've really highlighted is that early 2022 is when investors seem to acknowledge that the transitory inflation might be just inflation, and rates generally started trending upward, even though the Fed funds rate did not start increasing until March of 22. And so that's just really kind of a benchmark point. So with that, you can see our header and our key don't quite match, but we're pretty close there on our dates. But that blue line represents where rates were that first week of 2022. And you can see a more traditional yield curve. Now look at that green line or yellow line, and you can see there we have an inverted yield curve. The 1-year rate is higher than the 2-year rate. And that's a relatively unusual activity where an investor will require a higher interest rate to lend for a shorter period of time. We'll show you some more charts on how that impacts the overall yield curve going forward. But this is the Treasury yield curve, and we showed that comparison. So not only do you notice the difference in the yield curve, but just the difference in rates. It costs a bit more to borrow in May of 2023 than it did in January of 2022. And you've seen that across the board, whether it's car loans, mortgages, any number of things. Okay, this is another chart that we've really started in the last, actually this one's been around a little bit longer, but so call it mid-2022, we started looking at this. And what we're focusing on here is that change in the 30-year MMD. And keep in mind that the 30-year MMD is not as high as the shorter term rate. So you haven't seen as much of an adjustment there, but it is a key data point to take a look at. And if you go to the far right, I think one thing I want to have you take a look at is the change for the prior month is the smallest amount we've had of any change. If you look there, so we're at 9 basis point change through the month of April. I think our next lowest there was 22. You see that in November of 22. And then you saw a pretty modest change in the month of March, where on April 3rd, you see a change of 26 basis points. So I'm not sure what this means going forward, but we've had less movement on the 30-year MMD than we have other months in this time period that we're looking at here. I mentioned I would talk a bit about how the fact that the shorter term rates are higher than the longer term rates has impacted the yield curve. And that's what you can see here is while we go back to 2005, and if we look at the shaded green bars in each one of the maturities, that's the range of interest rates that we've had during that period of time. What that blue line represents is as of last Friday, May 12th, 2023, what the MMD was for each one of those maturities. And so just to highlight something here, for investors to lend for 1 year, the yield is 2.99. But if they were to lend for 2 years, it's 2.69. And you can see that trends all the way down through year 7 there to 2.25. In order to get equivalent yield from a 1-year loan, you have to go all the way out to the 17-year mark. So between year 16 is 2.94, year 17 is 3.01. And so for very short lending, it is a bit expensive compared to the other maturities on the yield curve. Another thing I find very interesting is that 2.99 for the 1 year, when you compare that to a 30-year at 3.36, so only a 37 basis point increase during that period of time. And so we'll see how this changes over time, but you can certainly see those shorter term maturities, which would traditionally have lower interest rates than the longer term maturities. I certainly don't right now. That trend's been going on for some time. This chart, we try to throw a lot at you, just kind of give you a summary of some things. You can see here at the far top left, we are looking at monthly bond issuance volume, and you can see we are certainly lower than we have been in previous years that we've looked at here. Far right top, you can see just the issuance, both on the different types of bond sales. One thing I've highlighted that in a prior MMU, that the regional banks did a lot of the private placements that we're calling here, or direct placements. And so with some of the struggles that they've had, you can see that I expect you will not see as much private placement debt. And so that will, whatever issuances we do have, will probably trend more towards negotiated and competitive. That's something we should watch over time. Bottom left there, taxable versus tax exempt. You can see we did a lot of let me take a step back there. Generally a little bit lower trend, but you can also see with tax exempt versus taxable, like in 20 and 21, we had a lot of tax exempt. I think a lot of those were refinancings where we did them on a taxable basis, and the taxable yields were so low that you could actually refund tax exempt to taxable during that period of time. Don't think we're going to see that in the too near future here. And then to the bottom right there, refunding versus new money. With rates higher, you certainly have less refundings. I mean, certainly look at that 19 and 20 time frame. We had over 30% of the transactions being refundings. So this is just something we try to provide on a monthly basis to just give you how things are trending. Then one of the key factors for interest rates is money flowing in and out of the bond funds. And if it's green, money's flowed in. If it's yellow, money's flowed out. And so you see we've had a lot of money flowing out of the municipal bond funds. What I'm hearing from bond underwriters that we do transactions with is while the funds have had outflows, some of the SMA, separate managed accounts, have actually had inflows. And so it might not be as dire as this chart is showing. And I think, but one of the things we're having trouble finding on Bloomberg or another data source is a way to track inflows or outflows into the SMA. So we don't have a chart like this to show that to you. I'm just giving you the commentary that we've heard from the underwriters when we've done pricings for our municipal clients. On this last chart, we show the supply. May 8th, that week of May 8th, last week, really felt like a busy week, and April 17th did as well. And so you can see those were 2 weeks where we've had more volume than we've had in other months.
or I'm sorry, other weeks. And but you can see this week we do have a bit lower volume than those two. So it was fun to see all that activity, but we once again are a little bit below that. And this is actually pretty important when you see that we don't have as much money in the funds to buy these bonds. And then you actually see supply down. That helps, because if we had a whole lot of supply and less money available to buy those bonds, you certainly would see upward pressure on bonds. But with supply down and then having some lack of interest, hopefully that balances out and keeps rates on the lower side of things, or puts lower pressure on them. Finally, on this last page, what we're highlighting here is the economic calendar. We do have a holiday coming up here soon. On our last page here, we have the Fieldman Rolapp Registered Municipal Advisors. I encourage you to reach out to any one of these individuals for more information. Also, please send us any suggestions or things that you'd like to see in MMU. We are certainly open to adding, subtracting, changing. This really is an effort to provide all of you relevant information. So please reach out with anything we could do to be helpful. Thank you for your time and look forward to talking with you in June.